the insurers and the shippers?
It's impossible to get insurance from European Union or from our like-minded partners unless you apply to this oil price cap. And that means that there is a limited market for oil tankers. Saying that, of course, there are also some big buyers of Russian crude oil who have received significant discounts already before. And our aim is to cut Russian revenues. We don't want to finance and we don't want to be involved with transport in case they can finance their war machine.
Well, Commissioner, you made it clear, and also you're prepared to take the financial hit for that. That's very clear from the European perspective at this point. Commissioner, thank you so much. Kadri Simson joining us from Brussels. And you heard it there. She says no blackouts this winter for the time being. Guy?
For the time being, yes, we're all going to watch the weather and watch the weather very carefully. I understand there's another cold snap potentially on the way. All of this, I suspect, is going to be stress tested before the winter is out. Maria, fantastic as ever. Thank you very much indeed. Our good friend and colleague Maria Tadeo speaking exclusively with the EU Energy Commissioner. Coming up, we're going to have more on what that EU price cap means for markets. Sean Morgan, Evercore ISI Director of Equity Research, is going to be joining us next. This is Bloomberg.
Well, wake up, Buenos Aires. You are looking right there at a live scene of major celebratory action happening in Buenos Aires. You had the Argentinian football team finally coming back with the World Cup trophy. It looks like quite a party, Guy. How many people must be there?
Yep. I don't know, hundreds of thousands.
Yeah.
It's a massive moment. It's Messi's Maradona moment. You saw him coming out of the plane. He walks out of the plane, kind of thrusting the World Cup in front of him. Absolutely amazing. He's not going to be stepping aside, which I think is amazing as well. He's going to carry on playing football. Argentina, I think they need something to celebrate, though. Very good at football, not so good at economics.
Yeah.
And I think probably that is the narrative here. So something to cheer them up. But yeah, this is definitely having that effect, certainly having a galvanizing effect on the country. It was interesting, the president didn't go because he was worried that he would be bad luck. I think he's probably hoping that the good luck on the pitch translates off the pitch for his country going forward.
Actually, you're not crazy with that, because there was an article that came out last Friday that talked about how the country that actually wins the World Cup gets an economic boost after that. So that's not an actually crazy thought to make. And if we're looking at France versus Argentina, Argentina definitely needs that boost much more than France.
Well, I'm glad it's not a crazy thought.
No, you're not crazy. Just not in this particular circumstance. I mean, maybe other times that's kind of up for grabs. Okay, a great crowd, lots of good energy there coming from Buenos Aires. Okay, we're about an hour into the trading session here in the U.S. Volume's actually not as terrible as I thought, and we're actually seeing a rally kind of get underway here with the S&P up 0.4%. Abigail's tracking those moves. Abby?
Yeah, Alex, it's hard to compete with that celebration, but this is an interesting board here because we have stock indexes here in the U.S. up for the first time in 5 days, and it is for a reason. It has everything to do with the BOJ's hawkish surprise there with the 10-year, the BOJ JGB 10-year being allowed to drift up toward 0.5%. That means that you have the dollar-yen down. That also means you have the dollar down. That is good for risk assets typically. So this may be the beginning of some sort of a bit of a risk rally, because it looks likely that we're going to continue to see this bearish action for the dollar, which we'll be taking a look at in a moment. But what makes this move so interesting, we have yields spiking right across the world. We have the global system really moving from an accommodative situation to a tightening situation. BOJ was first in decades ago. Now they're the last out. But this is the 10-year yield over the last 3 days, backing up 22 basis points. That's very healthy in the face of these banks that are tightening. And yet you have the dollar, again, down, helping out these risk assets. Let's take a look at the dollar on a longer-term basis. This is a big reason, at least technically, to think that we are going to continue to see the little bit of weakness that we've had recently continue. This is the dollar going all the way back to the 1980s. You can see the peak there. This is the dollar index. An overall downtrend that looked like it is on one level being broken out, but now it's starting to come back in. Lots of signs. We could see that dollar index go back below 100. If that happens as the Fed and other central banks are tightening, and again, just technical reasons here, but really the ping pong that we're seeing amongst all these central banks, it could again be positive for risk assets. If we take a look at the S&P 500 on the year relative to the Bloomberg Dollar Index, I'm kind of surprised that the Bloomberg Dollar Index is only up 6%, because at one point it had been up double digits, but that has to do with the decline. But Guy, take a look at the S&P 500 down 16%. So if the dollar index going into 2023 is down, might we see some sort of a macro tailwind for stocks?
Yeah, that relationship has certainly been quite interesting to watch. Dollar down, stocks up has certainly been one of the themes that has been worth paying attention to. Abigail, thank you very much indeed. European nations, as we've just been hearing, reaching a deal to cap the price of natural gas. We spoke moments ago with the EU Energy Commissioner, Kadri Simpson.
But we have to take care of our consumers and avoid the wartime premiums or marked up prices compared to the other LNG hubs. And we will do so. The mechanism will be ready if the prices are above 180 euros. And on top of that, there has to be spread at least 35 euros. So if other global hubs will also witness similar extremely high prices at the LNG markets, then we will not trigger this mechanism.
Let's talk more about that. Sean Morgan, Evercore ISI Director of Equity Research, joining us now to talk about this. Sean, when you mess with the market, normally you get unforeseen circumstances that can trip you up sometimes. What are you watching here? Do you think this is going to work?
Yeah, Guy. Well, thanks for having me. And I thought it was interesting, the lead-in with the Argentinian celebration, because that's obviously a nice little case example of what happens when you try to solve an economic problem with a political solution. And I think this is exactly one of those cases. And I was heartened, and happy to hear, and also to read that there will be a braking mechanism where they would suspend this gas cap in the event that it gets out of hand. But and I'm sure the Minister Kadri that you spoke with before, she probably has a much closer definition of what the gas hub price that they're indexing against is than I do, because I haven't been able to access those government documents. But you don't really even need to be able to see the government documents to kind of understand how this works from an economic standpoint, and why a gas cap is not likely to work.
So if I'm a U.S. producer, I know there's not that many of you, but if I'm exporting LNG from the U.S., is it good for me or bad for me?
It's somewhat neutral, and the reason is they're talking about pricing at the margin, the last cargo in. 85% of U.S. exports, for the most part, are done on a Henry Hub price. So Europe, for the portion of U.S. gas that they've contracted, is getting a very low U.S. price, plus a marginal liquefaction fee, and then shipping costs. And so what we're really talking about is buying spot gas. And so when does spot gas become expensive in Europe? It's when gas is too short. And this is the problem that they will run into if they do run through their gas reserves. And we could talk about, what that represents to total consumption. But if they run through their gas reserves and all of a sudden gas prices spike, and let's say it gets to the point where you hit that trigger, the problem is then gas that was being resold from Asia and spot buyers in China and India that are not buying because Europe is sending a strong price signal that they're willing to pay the highest price in the market. That gas basically gets burned in South and East Asia. And that's a problem. And interestingly enough, they talked about the spread between the basis, which you would assume would be JKM, Asian prices, versus TTF. Here's the problem. If you hit that trigger, and then all of a sudden you're consuming more LNG, that's the available spot cargoes in Asia, that's going to depress that price. It's actually going to increase the spread between the two of them, which, by the way, they've defined that cap would keep the cap in place. And that's exactly when they need to be buying as much gas as possible, if that makes sense.
Sean, yeah, it makes perfect sense. The other factor I think that's worth bearing in mind here is that OTC is not included. So if I've got an issue and I'm worried about supply, I'm worried about the security of supply, presumably I just ditch one market and go to another. I just go over the counter to get the cargoes that I need.
That's exactly right, Guy. And this industry, only recently became commoditized to the point where people were trading off of benchmarks. Previously, it was basically Japanese buyers and Algerian or Qatari sellers doing bilateral deals. And so, if you sort of remove the transparency you have with a very visible index like Dutch TTF, what does that do? Well, I don't think that helps European buyers get a better deal, because if you look at looking back at my career, I started in high yield bonds prior to the government introducing TRACE. That lack of transparency for the market, I don't think that really benefited the spreads that buyers were paying, and I think they effectively forced people in a non-transparent private market. Well, then you're hoping you have better data transparency than Shell, Vitol, Gunvor, and Exxon. And I think that's going to be tough even for the big utilities in Europe.
Hey, Sean, we really appreciate it. Thank you very much. It definitely feels like more problems than answers then. Sean Morgan, Evercore ISI Director of Equity Research. We really appreciate it. Thanks a lot. All right, coming up, making Swatch watches hot again. We're going to have an exclusive interview with Nick Hayek, CEO of Swatch Group. That's coming up next. This is Bloomberg.
Keeping you up to date with news from around the world. Here's the first word. I'm Lisa Mateo. A surprise move by the Bank of Japan. Governor Haruhiko Kuroda shocked markets by doubling a cap on 10-year yields. That sent the yen higher against the dollar. Many economists see the move as laying the groundwork for exiting a decade of extraordinary stimulus policy. China is adding weight to the speculation that it's hiding the true picture of how many people have died since the end of the COVID-0 policy. Health officials confirm they have narrowed how they define a death caused by COVID. Only those people who tested positive and died of respiratory failure will be considered a virus death. Negotiators in Congress have agreed to a $1.7 trillion spending bill. Now they'll send it through the House and the Senate to avert a government shutdown on Christmas Eve. The bill provides funding for government agencies through next September. It also includes more than $45 billion in aid to Ukraine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. Guy.
Lisa, thank you so much. Okay, so Business Week unveiling its Bloomberg 50, a look at the people who defined global business in 2022. Nick Hayek, the CEO of Swatch, certainly made the list. The iconic watch brand expecting to sell up to 500,000 Omega moon swatches this year in a highly successful internal collaboration. So will the story be even kinder to Swatch in 2023? How do you top a year like 2022 if you are Swatch? Nick Hayek joins us now. Nick, great to have you on the show. Thank you so much. Look, I have to ask, hand on heart, did you think that the Moon Swatch was going to be as successful as it was? You had people queuing round the block to try and get hold of one of these things.
Yes, and not only when we launched it, it's not a limited edition. It's up to today, 9 months later, the people are queuing. Look, we did everything to make it happen. That's why we kept everything secret. That was a challenge, you know. You produce this in our factories. Of course, we knew this is a bomb. This is something unexpected. And there will be success at the end of the day. But that it was such an overwhelming success, yes, that was a surprise.
Nick, is there going to be a Moon Swatch for next year, like a big surprise we can expect too?
You have already bought your Moon Swatch this year?
Yeah, well, Guy's getting it for me for Christmas, so I haven't actually received it yet.
Yes. Yeah, you see, then you have to go on 2023. Think a little bit more long term. I know in business in the US, you only think about 3 months. But 2023 will continue. The Moon Swatch is so hot that we will continue. But again, you know, the positive provocation and joy of life of Swatch is always permitting us to bring new things and surprising things into the market.
Were you worried that you were going to undermine the other side of the equation, the other side of the fence, the Omega side of the fence?
In the contrary. Because we tell the young people everywhere in the world and everybody who doesn't know the story of Omega. Oh my God, what an icon. It has been on the moon. You have to tell this story. And there are many stories that can be told. So Omega increased the sales after that we launched it. It's the contrary. The young people are fascinated. They want to know what is happening. And Swatch was the perfect means to do it. Swatch was always a communicator and brought new people to buy watches. It was like this in the past, and it will be like this in the future.
Nick, if we get into a recession next year for 2023, what happens to the business? What are you looking at?
2023?
Yeah.
You know, I'm not in the weather forecast, but I see there are so many opportunities out there that we can only have positive surprises as long as we stick to what we are doing, and the world should look what we are doing. We have our production bases in Switzerland, we have our factories in Switzerland, we have our research and development in Switzerland, even for a product that only costs $260. And as long that you have these bases, an industrial base, and you let not yourself be influenced by financial analysts and you do the contrary of what they are saying, then there is a lot of success waiting for you in 2023.
Nick, what do you think about Bernard Arnault being the richest man on earth?
I don't know him.
Okay.
What should I think about the richest man? What kind of value is to be the richest man on the world? There's no value in it. You have to
I asked the
people.
question. I asked the question because what he has demonstrated is the value that you can generate from brands like he owns and like you own. And I'm just wondering kind of how you think about that value and how you think about the ongoing journey that those brands are going to produce, how much further there is still to go with these brands.
Yeah, as I said, the potential is huge. You have billions of people in the world, and we showed it with the Moonswatch. You have young people, aspiring people that don't want to be excluded. You know, we all talk about exclusive, luxury, but all these people want to have very exclusive, fine products, not commodities, not only consumer electronics products. They want fine produced products. And there are billions out there. And they're just waiting that you go and offer them something that brings joy of life and positive provocation, especially after COVID. Mm-hmm. You know, we all during COVID have been blocked at home. We could not say nothing if you say something against it. So here there is the huge potential. And being rich at the end of the day is not the objective. You can become very rich at the end of the day, but this is not the objective. What is the objective? Is to bring something that adds value to the lives of the people through joy of life and through a positive provocation that makes move the people.
It seems, Nick, though, what Guy was getting at was also the idea that a luxury CEO is the richest person in the world, and that luxury has been so hot for all the reasons that you just said. Why do we think that luxury can stay hot if everyone has to pay higher electricity bills and hunker down in a recession?
But you know, you talk again about luxury. You have, on the other hand, I think you have the Walmart people and family who are very rich people. And Walmart is doing products for everybody. And so there is space for everybody. And when you talk about luxury product, I would not talk about luxury. Let's talk about exclusive product that create a desire to the people, that are emotional for the people. And it has nothing to do with the price. You see it in our example. We did not a limited edition. It cost $260. It's really accessible for everybody. Mm-hmm. And that's what it is about. And the luxury industry must be careful. If you always go higher in prices, you exclude more and more people. So your exclusivity is excluding people. You only serve an elite of people, and that's not what the future is. You have to seduce the mass of people, the middle class, the entry class, not just the rich people or the small elite that is out there.
Is that what China is about now, Nick? Is China about attracting a customer who has never bought such a product before? How do you see the Chinese market? It's reopening now. How big is that reopening going to be?
Oh, China is very strong. The people are very conscious of quality products. They know what is a commodity and what is a real fine product. The potential is huge, but not just on the luxury. On every single fine made product that has a message, that has an emotional message. They like this kind of things. But to come back to the US, I think in the US the potential is huge of people who want to have products that are emotionally driven. You have many products that are reason driven, health driven. But here you have huge potential. And of course China, 1.4 billion people.
Nick, before we let you go, I did want to ask about sort of watches becoming an asset class. So Rolex is going to start certifying pre-owned watches for resale by authorized dealers. Would you be looking to do the same?
For Swatch, you mean? Yes, we can compare Rolex and Swatch. It's very good. You know, we have also people who are reselling Swatch watches at the moment. But we don't need to certify them because you can buy them only in our own stores. So there is no other retailer that can have it. So the best is to come to our stores and you buy it there. So no need to do the same thing than one of these luxury brands is doing.
What about Omega? What about some of your other brands?
Yeah, Omega is doing fine. But you know, why should we mix ourselves into the market of used watches? This is a market that is regulating themselves. So the people are exchanging, and we have a track of the watches because we give a customer service. Let's think about it. In Omega, we have spare parts for over 30 years. We guarantee up to 10 years. So there is no problem to certify when you come to us and you have a problem that this is a real Omega. So you don't have to do a marketing operation of it. And the market is regulating themselves. The people who want to buy used watches, they can buy it as they buy many other things. They don't need us for it.
Hey, Nick, we really love talking to you. Thank you so much. Great to chat. Nick Hayek, Swatch Group CEO, thank you very much and happy holidays. This is Bloomberg.
So European equities are down a touch today. Volume's all right. Could be worse, I think, at this stage as we run up to Christmas. You would have thought you would have got a bigger reaction, but you've got to want to look for the reaction to the BOJ today because it is there if you look. So stocks not actually in aggregate doing very much, but the sector breakdown is absolutely huge today. You're also seeing it in the currency market as well. You are seeing it to a certain extent in the bond market, but I think the currency market is a bigger kind of story here. Look at pound. Look at the pound versus the yen, down by 4% today. So the yen really surging, and that's where the narrative seems to be. But it's also in European banks. Now, you've got some fairly hawkish commentary as well coming through from the ECB today, but nevertheless, you are seeing names like Commerzbank, 9% to the upside today. You've also got names like Deutsche Bank doing very well. Credit Suisse, that's a different story. We'll come back, we'll talk about Credit Suisse in just a moment, in the next hour, because that is a stock that is under significant pressure. You've got notes from RBC and from Citi, quite negative now that the capital raise is over. But Commerzbank definitely on the front foot. So there is a significant effect coming through from the BOJ, but you've got to want to go out and look for it and find it and look at what is potentially going to be the longer term story here. Anyway, somebody that's certainly been talking about this for a long time now has been Mark Dowding. He is the BlueBay CIO. He is going to be joining us next. From the last time we talked about the yen move, he was kind of on tenterhooks waiting to see what was going to happen. It is now starting to happen. We'll get his take next. The close is coming up. This is Bloomberg. Tuesday, the 20th of December. On the surface, European equities aren't doing very much today. DAX is down a bit. FTSE 100 is up a little bit. Below the surface, there is plenty of action. Banks are absolutely flying. Names like Commerzbank and Deutsche Bank. Real estate, yield-sensitive areas of the market, certainly under significant pressure. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So European equities as we head into the end of the day this Tuesday, a little soft, down by 0.2%, but a huge spread in terms of the sector story that we are watching. Banks at the top, real estate at the bottom. The bond market certainly reacting to the news from the BOJ as well. We've got the German 10-year up by around 9, nearly 10 basis points today, trading up at 2.29. How much more room is there to go? We've also had some fairly hawkish commentary once again from the ECB today. And then we come to the banking sector, because again, actually the spread within the banking sector is fairly significant. Names like Commerzbank, Deutsche Bank doing very well today. Credit Suisse under pressure. Two rather negative notes, one from Citi, one from RBC. Certainly weighing on this stock today. They worry, the analysts at those banks, about the lack of transparency around the restructuring plan. We'll talk more, Alex, about this later in the show.
All right, here in the U.S., similar story, Guy. S&P, though, is up by 0.2%. Again, not something that you would have thought. You're going to sell U.S. equities and go buy Japanese equities, not necessarily seeing that in a broad index level. Dig beneath the surface, a couple of idiosyncratic things going on. So General Mills reported earnings today. The overall idea is that price increases are happening, yet the volume is starting to slow down. The volume declines are ongoing. And their pet segment didn't do so well. Organic net sales were just up there 0%, so nothing, and the estimate was for 13%. Usually the pet thing always does really well, so that was perplexing a lot of analysts. Wells Fargo, we will talk about this in just a moment, about $3.7 billion worth of fines from the Consumer Financial Protection Bureau. We'll get to that in a moment. And then we are seeing a bear steepening happening in the curve, and this could be the BOJ effect, as the long end of the bond market selling off much more than the front, up by 10 basis points, Guy.
Yeah, the market is clearly taking this as a pivot. The market clearly doesn't believe that this is basically trying to add to the sustainability of yield curve control from Kuroda. The market firmly believes that this is the beginning of a shift, Alex. And it's interesting to see that we have had a reaction. I think it's been more nuanced today than maybe you would have expected. When I woke up this morning and saw this news, I was expecting equities to be under pressure across the board. I was expecting a massive move in the yen. I think we have got a big move in the yen, but I think it could have been bigger, and a huge move in the bond market. I think it's much more subtle than that today already, which I think is interesting.
Yeah, but I also feel like potentially it's because it was sterilized. I mean, Kuroda at the presser also talked about how the BOJ is going to boost their JGB purchases. And that's like a perfect thing, right? You do a lot, but you don't move the market. You do a lot, but you sterilize it, so there is no turmoil in the market. And I wonder if that's just like the case point. If you don't do forward guidance, this is what you can actually do.
Yeah, I think it's going to be a slow burn, though. I hear what you're saying about maybe kind of one offsetting the other, but I do think the effects of this are going to take a little while, but when they start to get going, when that money, then that Japanese money starts to move, we're going to see a fairly significant effect. Anyway, let's hear from the man himself. This is what the Bank of Japan Governor Haruhiko Kuroda had to say earlier.
The volatility of the financial and capital markets seems to have declined temporarily, but it has increased again recently. The distortion of the yield curve has become very strong, so we made some adjustments today. This is just to ensure that yield curve control functions steadily and does not mean a beginning of a rate hike, tightening monetary policy, or reviewing YCC.
The market's not quite so sure about that. Yes, fine words. Yes, we're going to continue with the policy. Yes, nothing has really changed. We're widening the band a little bit. We're trying to manage the process, make it maybe a little bit more sustainable. Market's not taking it that way. The market believes, as I say, that this is a significant pivot, a big change from Japan. Bloomberg's Kathleen Hayes joining us now in New York to give us her take. Here in London, Aileen Oyamada to give us a take as well from the FX point of view. Aileen, let me start with you. Got a 4% move on the yen. Is that the kind of move that is commensurate with the ending of what has been one of the biggest monetary policy experiments we have ever seen? Or is there more to come, do you think?
Definitely more to come, or at least that's what investors are saying. Like you said, no one is taking this as not a hawkish pivot. It is a hawkish pivot, and I think everyone is expecting the market to adjust in coming months. It's interesting, though, that it wasn't as disruptive as we would think initially, right? This is something that we've been hearing a lot for a long time. The short GDBs trade has been very popular and unprofitable until then. But I think it's also something that everyone expected to happen at some point. The timing was surprising, but it was a move clearly that would happen at some point. So this is why we are seeing some of like not a really bad market today. And there's some yen move, but everyone expecting more to come for sure.
So Kathleen, you've been covering the BOJ for quite a long time. What is the sequencing now from here that you would expect?
Well, there's a couple of very important things here. And one is that the Bank of Japan is getting a new governor, and the new governor will be in place by April. And so the question is this new governor going to be the one who actually moves this whole process, which probably will be a long process, of gradually widen the band even further, gradually dropping the yield curve control band at some point. Governor Kuroda then has about, 3.5 months left. So is this a move to sort of buy him time while the yen might come under attack again, while they might be forced to buy even more JGBs again? And or is it clearly a sign they're moving forward? I would say most people have been. It's clearly a sign that, as everyone expected, when Governor Kuroda got to the end of his second 5-year term, this would be the point where the BOJ could start moving out of extraordinary stimulus. Now, the question hanging over Japan's economy is what happens next. The economy was slightly negative in the third quarter. They've come through COVID in decent shape. They've got a mixed outlook. They've got a Federal Reserve overseas whose hiking rates aggressively could cause a recession. A recession would hit Japan very hard. Governor Kuroda and his team have continued to insist that they're concerned about the economy next year. They are also concerned that inflation, which is now well above target, their key measure is the headline minus fresh food, and that's up to 3.6%, but they think it could fade next year. The process has probably begun. There's been signs from the government, the new Prime Minister Kishida, saying that not publicly yet, that they are going to look at this 10-year program of extraordinary stimulus and have a review of it. The door's open. It's going to be walked through at some point. How quickly, I think, as Guy says, that remains to be seen.
Well, let's just talk a little bit about the timing, Kathleen, and just kind of figure out what was happening here. Maybe this is just designed to make the policy a little bit more sustainable, but do you think that Kuroda had his hand forced by how hawkish Christine Lagarde was the other day, how hawkish Jay Powell was the other day? Do you think they were maybe surprised that other central banks, other major central banks are pushing as hard as they are, and as a result of which they had to take action now rather than waiting?
Well, it may be a little more complicated than that. I'm not sure they were surprised, and certainly by if you've been listening to the Fed and you're a career central banker like Mr. Kuroda, you're not surprised that they're remaining hawkish because inflation remains so high in the U.S. Another factor here is political pressure. High inflation, a weak yen, very unpopular among the Japanese people, and this is something that some are conjecturing that this is another pressure that was put here just to put a little relief there. Kishida's approval ratings are way, way down. Another reason why they're probably looking at appointing someone to carry the policy forward who will take over in April, who is more in the camp of, look, we've got to drop the extraordinary stimulus. We've got to start removing some of the liquidity. And in fact, the government bond market is owned 50% now by the Bank of Japan. That's an increasing concern as well.
Yeah, absolutely. Aileen, last word to you on this. Where do you expect the biggest reaction in the market to eventually transpire?
I think markets will be very attentive to all the communication coming from the Bank of Japan, and obviously the next meeting is not that far away. It will be in the end of January. That will be the second to last meeting from Kuroda. So they will definitely want to see more speech if they will go further on that hawkish message, and therefore change the rate differentials in favor of the Japanese assets.
Right, which and then what do you sell to then wind up going back and repatriate? We're going to talk about that in just a moment. All right, guys, thanks a lot. Really appreciate it. Kathleen Hayes and Aileen Oyemeda, thank you very much for joining us. So coming up, we're going to continue this conversation with Mark Dowding, Blue Bay Asset Management CIO. He was short JGBs ahead of the BOJ pivot. He's still going to continue shorting. We're going to get his take next. This is Bloomberg.
The top names at the Fed are on Bloomberg.
I do see growth slowing, but remember that's part of the mechanism of getting demand into better balance with supply and alleviating those price pressures.
We're clearly not in a recession right now based on the data. It is an economy that is growing only modestly, and I think it's an economy that's really seeing the imbalances between supply and demand diminishing and inflation coming down.
Nobody covers the Fed like Bloomberg, your global business authority.
Let's stick with the BOJ. Blue Bay Asset Management says it is sticking to its short JGB positions at the moment due to expected higher bond volatility going forward from here. Yields are expected to rise further. We've been hearing about potentially how far the yen trade could go. Let's get back to our question of the day. BOJ, shock and yawn, i.e., could we have had a bigger reaction today? Well, let's get Mark Dowding, Blue Bay Asset Management CIO's take on that question. Mark, you've been itching for this trade to come through. It is finally coming through. Were you expecting the reaction to maybe be a bit bigger today, or was this how you thought things were going to play out?
Yeah, so I would say that the Bank of Japan is going to be pretty content with how markets have moved today. It was a pretty orderly reaction. Obviously, in terms of the exit or the pivot that we're seeing from the BOJ here, the fact that they're increasing bond purchases in Q1 and Kuroda has been very careful in his language, I think has helped keep a lid on asset price moves today. And I do think they're going to defend the 50 basis point ceiling very aggressively for the next few weeks. But ultimately, from our perspective, we think this is all about the data. We're seeing inflation data again on Thursday. We think that's going to be moving upwards once more. And as we move into the first quarter, with the Japanese economy doing relatively well compared to other economies as it comes out of the pandemic, we do think that higher inflation is going to be putting pressure on that ceiling in the due course of time. And so we'd expect to move up to 75 basis points from the BOJ in terms of the upper window by the end of March. That's what we're looking for at this particular point. So I think there will be more to come.
So you'd be shorting JGBs until we get to 75? Is that the trade you're looking at then?
I think that's correct. I think the risk reward is still very much skewed towards higher yields in Japan rather than lower yields in Japan. So we're very content to continue to run the position. It still strikes me that a lot of domestics who are the big holders of Japanese government bonds haven't really sort of started moving their portfolios yet. History tells us when they start to do so, you can end up with some fairly material moves in yields. And so I would expect to see yields materially higher, up towards 75 basis points before the end of this current Japanese fiscal year at the end of March.
How is this process going to work? Do you think the market is going to push at the upper end of the 50 basis point line in the sand? Do you think that they will be aggressive in doing so? I'm wondering how you think this is going to play out. Today, I didn't even see the market moving up to that line in the sand, which I was surprised about. But as you say, and Alex has been pointing out as well, there is going to be additional buying. When does the first test come, do you think, Mark?
Yeah, so the first test could come on Thursday. If we do see an above consensus inflation print on Thursday, you could see yields testing higher at that particular juncture. So that's worth looking for. Otherwise, I think that realistically, we're more likely to see the 50 basis point ceiling challenged, I reckon, for the first time when we get to the next BOJ meeting at the end of January, because there will be expectations that there could be a further adjustment perhaps running into that. I think some of this is maybe a little bit premature. I think a move up to 75 is probably likely to wait until later in Q1. But I would sort of emphasize that some people have been expressing surprise that Kuroda is doing this before leaving office. I think it is just credible, sensible central banking. The BOJ are looking to leave yield curve control, and you don't want to leave the difficult job for your successor to deal with the moment they take office in April.
Sensible central banking? What? Mark, come on now. So if we continue to see this, I'm wondering what assets do you think investors will be selling to then repatriate funds into Japan, and if you're taking on that trade at all?
So I think that's an interesting question to ask. I think that what we do see is if JGB yields are going higher, that's likely to have a knock-on impact on other global assets. We'd like to think that in that situation, global yields will be moving higher. So having seen Treasury yields rallying sort of in the last number of weeks, we do think that sort of Treasury yields could be pushed higher by upward moves in JGB yields. So we would sort of have a somewhat cautious view on both sort of fixed income here, also on equity markets. We feel that there is a bit of a sense that we saw a very strong up move in November, a lot of people wanting to front run what they thought could be a rally in 2023. I think the BOJ has now given investors something else to think about, and on the back of a series of hawkish central bank meetings from the Fed, from the ECB, even the RBA as well today, we do think that maybe the idea that the Santa rally is here to deliver a nice end to the end of 2022, it could be a more challenging few weeks, we think, in financial markets.
So Mark, how are you positioning? What's the trade? What's the Blue Bay kind of take on all of this? How are you going to work your way through this process?
Yeah, so we're very happy being short rates here across our global portfolios. We think we can make money by looking for yields to rise, both in Japan or also in US rates as well. We have been sort of paring back exposure on credit. We're not wanting to run a lot of directional risk on credit, but we do like banks. Something I've highlighted before. We think the bank valuations are relatively cheap, and it was interesting today that even with Japanese stocks moving lower, the Topix Bank Index was up about 5%, even with the rest of the stock market going down. And it shows you that banks can be in good shape when rates go up. And this is a theme that we think we'll see sort of globally, and that leaves us more constructive in that part of the market.
Hey, Mark, really appreciate it. Really fun stuff today. It's nice on a Christmas week where you get actual news. Mark, appreciate it. Mark Dowding, Blue Bay Asset Management CIO. Thanks a lot. All right, coming up, big banks, big trouble. That pretty much sums it up. Overhaul concerns, allegations of consumer mistreatment, and executive departures. We're going to break down all the latest news from the world's biggest financial institutions up next. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Lisa Mateo. Deutsche Bank may give some of its top earners in Germany and other markets an elevated pay hike to offset inflation. Bloomberg's learned that base pay could go up by as much as 4% on average. At the same time, the firm may cut bonuses for investment bankers who've underperformed. Two Morgan Stanley executives on the block trading desk have left the firm in the midst of a U.S. probe into their group's work. Pavan Pasi and Charles Leisure had been placed on leave and left in limbo. Bloomberg's learned their departure was accelerated over their unwillingness to work closely with the bank during the inquiry. No one has been accused of wrongdoing. And Wells Fargo has agreed to a record multi-billion-dollar settlement to resolve allegations it mistreated customers. The total, $3.7 billion. Now that includes a $1.7 billion fine that's the biggest in CFPB history. The agency cited Wells Fargo for what it called widespread mismanagement of auto loans, mortgages, and deposit accounts. And that's the latest Bloomberg Business Flash. Alex.
All right, thanks so much, Lisa. Let's stick with Wells Fargo for a moment. Bloomberg's Wall Street correspondent Ashali Basak joins us for more. There's a lot to get through here, but this is a really big number for Wells Fargo. What is this in response to?
This is in response to a lot of the issues we have seen them going through pre-Charlie Scharf era. This is foreclosed homes, illegally repossessed vehicles, inappropriate fees, interest charge, surprise overdraft fees. There's a lot of issues here, over millions and millions, tens of millions of dollars worth of accounts. Again, remember, this is a record fine for the CFPB, which was created in the wake of the 2008 crisis here to protect consumers. The $1.7 billion civil penalty is in addition to $2 billion worth of civil redress. So how is the market baking all of this in? Remember, Wells Fargo said that they would book a multi-billion-dollar loss, pre-tax loss, in the fourth quarter. That is a pre-tax operating loss of $3.5 billion. All of these are massive figures here. Remember, they already booked $2 billion in the third quarter to cover legal and regulatory charges. The big thing here is it's not even done yet. So you have this massive CFPB fine here, but on top of that, you have more regulatory issues ahead for Wells Fargo. What analysts believe now is the good news that can be baked out of booking this fine is the idea here that they get closer to the ultimate goal of knowing how much these legal fines will cost them at the end of the day and get them to the ultimate goal of getting rid of that asset cap that has been imposed by the Fed. So yes, it's certainly a lot of money. It is certainly very costly. We'll see some of this in the fourth quarter. It is not done, and it should bring them closer to ultimately getting past this scandal.
Sonali, another bank that's going through a fairly major restructuring is Credit Suisse. We've seen the capital raise. The expectation was that to a certain extent, we now need to see the bank delivering on some of its targets. But we're getting a series of analyst notes out, I think it was Citi and RBC today, just saying there's not enough transparency to understand what is happening here, pouring cold water on the idea that this can be delivered upon. What is the street making of all of this? Can we sound the all clear on Credit Suisse? Is it kind of uphill from here, or is it going to be tough walking?
Tough days ahead, certainly for Credit Suisse. You see it in the stock price as well. 5 days of declines over in Switzerland as it's been trading. Remember, Citigroup and RBC, the reason we're seeing them come now with these notes out is because those two banks were part of the capital rights, the raising plan. So now they can come back out and initiate again coverage. So you have Citigroup saying that they have little conviction in the plan, and you have RBC saying the next 2 years will be a transition year. I'll give you what I have on the record and on background from my own sources. On the record, we have those notes that show you what a lot of the buy side is saying in the background, that this is going to take time. There's a lot of uncertainty behind these plans, both in terms of actual details proposed in these plans, as well as what you can expect from them moving forward. Really quickly, too, this is days after the U.S. said the living will was inadequate. So you have both regulators and investors here drawing concern.
Plenty of people worried about what is happening here. I suspect the Swiss certainly at the centre of that. Sonali, great stuff as ever. Thank you very much indeed. Bloomberg Sonali Basak was going for a whole kind of walking out thing that didn't really work. FTSE 100 a little higher today. DAX down by around 0.4%. CAC as well. Closes next. This is Bloomberg. 2022, it's not done with us yet. Today, the BOJ absolutely front and center, having a significant impact on European stocks and assets more broadly. Let me run you through what we've seen and the impact that it potentially could have. When you look at the map, you're not getting that big a reaction. The reaction is elsewhere. Well, it's kind of below the surface. So the FTSE's absolutely flat on the day. DAX is down a little bit. CAC's down by a little bit. IBEX kind of down, up by 0.6%, while the Milan market is absolutely flat. I don't think there's a clear signal out of that, because what you've then got to do is go kind of 1-2 layers below that. So let's look at the session. You can kind of see how we've been progressing today. The move came kind of fairly early on, and we've been kind of bouncing around just below the flat line ever since then. What you've got is kind of the bulk of the weight on the downside, but some really key sectors moving on the upside. You're also getting a move into the bond market, into the FX story as well, which you've then got to factor in as well when you think about the translated earnings story too. So let me just show you kind of what has been happening there and give you an idea of what's been going on. So you've seen euro dollar, a little kind of movement there, but it's been the yen crosses where the real action has been. So the German 10-year up by around 10 basis points, perfectly on cue. Pound yen, sterling yen, as you can see, that trade is continuing. So the pound is now down against the yen by 4%, over 4% now. But people are talking about that trade and all the other yen crosses having much further to go potentially. Euro dollar, just as a point of comparison, fairly flat today. Back to around 106, 106.28 is where we're trading at the moment. So just to kind of, that gives you the benchmark, just to give you an idea of what some of the other movements have looked like. The yen crosses have continued throughout the day to get stronger and stronger and stronger and stronger. And you just kind of wonder whether or not we are going to see kind of moves all the way, for instance, dollar yen to 120. Okay, so that's that story. Let me just show you what's going on with the sector breakdown, because here, look at this. That's where the action is in the banks. 1.7% on the upside. Bottom end, real estate, the car sector, technology, all moving on the downside. I think the car sector is interesting. Japanese car sector maybe a little bit more interesting as a result of all of this. Anyway, let's wrap up on some single names, give you an idea of what is going on there. As I mentioned, banks front and center. Commerzbank now up by 10%. Now, you're going to see some unwinding of positioning here, but nevertheless, that is a big move. By comparison, Credit Suisse down by 1.8% today. That just gives you an idea of how much Credit Suisse is missing out today. And then you come to a number of the utility names. ENGIE today under a little bit of pressure, down by 2.82%. This comes down to a number of issues, including the Belgian nuclear issue, but also more broadly, windfall taxes and what's happening with the bigger story surrounding the energy narrative here in Europe. But windfall taxes, they're starting to give us an idea of what those are going to look like and the impact that they're going to have. Energy down by 2.82% on the back of that, Alex.
All right, Guy, let's get more in depth here. Let's start with banks, because is that going to be the trade with the BOJ? Charlotte Ryland, CCLA Investment Management, co-head of investments, joins us now. Charlotte, is it a buy bank kind of situation?
I think, clearly if you've got rates moving up, there's a better situation for banks than certainly quantitative easing was. But I suppose for us, the question is going to be what state is the economy in? And our view is that, as we move into next year, very likely to head a recession in the UK, in Europe, definitely a slowdown in the US, possibly or not a recession. And that's a much more difficult environment for the banks as well. So I think, it's not a one-way trade on that. So it's clearly high rates better, but it's not as easy as that.
Is the BOJ pivot something that you're going to think about as you go into 2023? And do you think kind of preconceived ideas of what next year is going to look like, has it in some way upended those ideas, or do you think this was something that was coming anyway?
I think, Japan was the last holdout for quantitative easing, and there seemed to have, with Kuroda leaving next year, that seems to have been, the pivot has come now through that they're actually going to say, well, the yen has fallen significantly. We have got some inflation, clearly not as big of an issue as you've got in the US, and that they are going to have to do something about that. But I think, there's not much evidence that Japan are going to be following the Federal Reserve and putting up massive increases, because they simply don't have the same inflation problem, they don't have the wage inflation problem, and you would expect that things like food and energy beginning to tail off as we move into next year, that inflation might dissipate quite quickly. And this is an economy which has been battling deflation for decades, and so therefore to rush in now and try and clamp that down on the economy, I suspect not. So moving away from zero, but, probably not a vast increase.
But Charlotte, nevertheless, if we do see some sort of repatriation for Japanese investors, what assets do you think are most vulnerable? Guy and I were talking earlier about, you look at Australia and South Korea, and their bond yields are up like 20 basis points today. Like, do we know where some pain points may be?
You know, it may be some money coming out of the US Treasury market as well, but I suppose if you look at the yield differential between the US and Europe and Japan, it's still, you know, pretty compelling. You're going to get a much better return in those economies than you are, say in Japan. So I think it's probably not a huge repatriation.
Would you buy Japanese equities?
I think there are some great companies in Japan, also on a selective basis, you know, something like a Keyence, for example, which is a leader in some of its fields, are quite interesting. But I think in general, the problem with Japan has always been capital allocation, the fact that they're sitting on huge amounts of cash, they tend to be conglomerate businesses, you know, and the returns on capital are just not that compelling compared to the rest of the world. And equally for the good businesses, you know, the valuations can be quite extended.
Charlotte, what do you think of EM then? Because it feels like EM has sort of becoming somewhat of a consensus for next year, right? You get a weaker dollar, particularly backed up, say, by the BOJ. Is that good for EM? Are you playing it?
I think for emerging markets, I mean, I think, you know, that's been the call, the problem people say, but I think for us, you know, we haven't got a commodity super cycle, which is what you had in 2000, and really drove those emerging markets. You know, China is still a big question mark. Yes, they've stepped away from zero COVID, but, you know, they've now got to get through the issue of you know, potentially millions of people having COVID and the strains that's going to produce on their healthcare system. Yes, they've stepped away from clamping down on the property market, but it's still, you know, a difficult market in terms of the politics as well, and the tensions with the US. So, you know, for us, you know, we can see that if you just look at the index level, those EM markets looking cheaper, but I think there's still some pretty big headwinds.
We are seeing higher yields, though, to Alex's point about what we saw in Australia, etc. We are seeing it across the board today. As Japan completes the kind of the big central banks moved away from super easy policy, should we assume that rates are going to be higher for longer? And if so, am I avoiding anything next year that has significant downside rate sensitivity? Where are those areas? Where am I avoiding on potentially higher yields?
Yeah, I mean, I think we need to be very careful about any kind of company that's got a lot of leverage on their balance sheet, particularly if it's floating rate debt and they haven't actually sort of got those rates fixed in. And, you know, but I think a lot of that has actually been priced in terms of, you know, that discount rate rise. So something like real estate sectors, for example, they've already sold.
So is it an earnings story? It's not a yield story next year, it's an earnings story.
I think probably so, because I think, you know, we've clearly seen that inflation has peaked, and we can have a question mark about how quickly that pulls back. And I suspect it will probably be higher than, certainly higher than the 2% that central banks are looking for. And therefore central banks will not be cutting rates dramatically. I think that's probably too early to be calling for that. But in terms of that de-rating story, which has been what dominated this year, I think next year is going to be much more about the earnings.
So then are you of the view of Mike Wilson of Morgan Stanley, where we wind up seeing a big re-rating in earnings? We're going to go below the low here in the U.S., for example. Like the first half's really bad, but then maybe the second half gets better. Is that your view?
Yeah, I mean, I think going into next year, we're staying pretty cautious. We're staying underweight in equities. We're staying very much focused on quality businesses, where we're not going to see that sort of cyclical downturn coming through. And it will depend on how things, you know, square out in terms of the earnings as we move into the second half, whether there's opportunities emerging.
Is single stock selection the key to success next year?
Yeah, I mean, I think, you know, we've had a decade in which you've had falling discount rates, and that's pretty much pushed up everything. And I think now it's going to be much more a question about making sure you've got the right earnings and the right companies that are going to survive in this environment.
But you've been paid to go passive over that period as well. Has that era now come to an end?
I suspect it's going to be a lot more difficult. I suspect it's going to be, you know, markets in which, you know, returns overall are not as good as they have been, and therefore it's going to be very much about picking those right sectors.
Charlotte, great stuff. Thank you very much indeed. Charlotte Ryland, the CCLA.